What's up guys, welcome back to InvestingPH. With all that is happening, the PSE market is going wild. But though our portfolio is going down, there comes an opportunity for us to buy great companies at a discount. So for today's video, I would show you 5 undervalued stocks on my watch list. With that, let's start. Before we begin, I would appreciate it if you click the like button, and if still aren't subscribed yet, do hit the subscribe button as well. Our first company for today is D&L Industries. They are a Philippine-based holding company and through its subsidiaries operates in 4 segments: food ingredients, colorants and plastic additives, oleochemicals, and aerosols. If you want to know more about their subsidiaries, I have a stock analysis of D&L. There's a link down below. Now, the company's stock price was already affected even before the pandemic hit. This was because of the China trade conflict. Looking at their financials, D&L's revenue had been constantly growing ever since 2011. But in 2018, when the trade conflict began, their revenue had a negative growth, plus the COVID pandemic. But in their latest 12-month, they got back on track. For their 10 years compounded growth rate, they are growing at 21.95%, and in their 7 years, it's at 10.56%, which is good growth for them. Going to their net income, the same story as their revenue, dropped during the pandemic, and in their latest 12 months, they've already slightly recovered. With this, they have a 10-year annualized growth rate of 16.30%. As to how well they are producing net profits from their revenue, their net profit margin for their business is at 10 to 12%. Now, D&L's business is unique since in some of their business, they don't have any competitors. And in their food ingredient subsidiary, they almost have a monopoly of it, gaining all the large clients in our country. Again, I have a video for it explained in detail each of their subsidiaries. For their equity, since 2012, they've had a positive growth. It only slowed down 2018 onwards, which is like almost all companies during the pandemic years. With this, their annualized growth rate for 8 years is at 14.50%, which is another good growth for them. For their FCF, things got a little bit messy, especially during the pandemic years, but this is fairly normal during these times. And both profits and equity of the company are growing every year, so this isn't alarming for me. As for how well they are handling their debt, they have a debt to equity ratio of 0.43, which is really low. This means they only have 0.43 pesos of debt for every 1 peso of equity. And for their short-term debt, they have a current ratio of 2.05, meaning they have 2.05 pesos of current assets for every 1 peso of current liabilities. With this, D&L can pay up all their short-term obligations. So for the 2 debt ratios, we can say D&L has a very well-handled debt. For my buy below price, my computed intrinsic value for them is 11, and with a 30% margin of safety, my buy below price is 7.14. The next company is GT Capital Holdings, so another holding company. Now, GT Capital holds a lot of large and well-known companies such as MetroBank, Toyota Philippines, AXA Insurance, MPI, and Federal Land. Their stock price has been stagnant for quite some time now. By the way, if you want to know more in detail about this company, I also have a stock analysis video of it, linked down below. For their financials, their revenue had been growing ever since 2010, and like all companies, in the COVID years, their profits were cut down hard. But even with that, for their 7 years compounded growth rate, it's still at 7.52%, which is still a good growth for them, despite the sudden negative growth. For their net income, same as well, but we can see a larger cut in 2020. This can be explained by the businesses they are holding. MetroBank had a massive cut in their net income because they put away more provisions during the pandemic years, and their MPI holding, which was affected big time in their toll business. Though in their latest 12-month, they've recovered quite a bit, they are still far away from their pre-pandemic numbers. Still, they have a 7 years compounded average of 4.78%. Now, I'm not using their 10-year average since they got most of their holdings from 2013 onwards. And as for how well they are producing net profits from their revenue, their net profit margin stands at around 6 to 8%. Now, it's hard to compare GT Cap to other holding companies since their business is really diversified. For their equity, ever since 2010, they've always had a positive growth, having an annualized growth rate of 20.30% in 10 years and 11.80% in 7 years. As for their FCF, same with D&L during the pandemic years, they also had a negative FCF. But remember, GT Cap has a bank holding, at which most bank companies has a negative FCF due to the nature of their business. For their debt ratios, GT Cap has a debt to equity ratio of 0.94, quite good for them knowing they have a bank holding. And for their current ratio, they have a current ratio of 2.32. This means they can very well pay up all their short-term obligations in a single year and still have more to spare. With this, for both debt ratios, we can say GT Cap has a very well handled debt. And for my buy below price, my computed intrinsic value is 854 with a 30% margin of safety. My buy below price is 597. For our third company, we have MetroBank, which is one of the holdings of GT Cap. Most bank companies have still yet to recover from the effects of the pandemic. Now I look at the bank companies' financials differently. First off, their net interest and non-interest income. What I want here is for net interest income to be higher since this is from loans they give out, and non-interest income is from other activities such as trading. With this, we can see MetroBank's income in both fields had increased even amidst the pandemic. If we add these two up, we get their revenue before provision. With this, we can see they've been growing their revenue pre-provision ever since 2010. Banks usually put aside provisions to protect them from unpaid loans. This explains why their total revenue is somewhat lower. And if you look at 2020, they increased the provisions they set aside. Since if you think about it, during the pandemic, a lot may not be able to pay up on time their debts. This is why banks set aside a larger amount, thus explaining the sudden drop in their revenue and as well in their net income. So connecting this to GT Cap a while ago, this is why their net income was also affected since they hold MetroBank. Knowing this is important since you know without provisions, even during the pandemic, MBT's revenue increased. But even with that, their 10 years net income annualized growth rate is at 9.48%. For their equity, they've been consistently growing every year. Though their latest 12-month is still at a slight negative growth, let's see if this will change once 2021 financials come out. Their 10-year annualized growth rate is 13.61%, so a good growth rate for them. Next is their total loans to deposit ratio. This is used to assess a bank's liquidity by comparing total loans to its total deposits. For MBT, it's at 75%. Too high of this may mean the bank may not have enough liquidity to cover any unforeseen fund requirements, and too low may mean they may not be earning as much as they could. The typical for this is at 80 to 90%. So for MBT's case, quite low than usual. But if you think of our state right now, this is quite normal since we are experiencing a pandemic. Another thing I look at for banks to see if it's undervalued is their price to book ratio. A price to book ratio less than 1 indicates the stock price is trading below the book value of their company, at which in MetroBank's case, they have a price to book ratio of only 0.72. So we are buying their book value or equity at a discount. And as I mentioned earlier, most bank stocks were hit hard during the pandemic, seeing as though AUB and China Bank's price to book is also at a discount. Lastly, my computed intrinsic value for them is 83. With a 30% margin of safety, my buy below price is 58.1. The next company is Megaworld. Like banks, real estate companies were also largely affected by the pandemic because of the closure of malls and the limited capacity of hotels. With this, Megaworld's stock price plummeted and had been stagnant for quite some time. Looking at their financials, their revenue had been consistently growing ever since 2010, except for the pandemic, at which they still haven't yet recovered even in their latest 12 months. This can be explained simply because there were still a few months that we had a high level of restrictions limiting their business operations. But even with that, their 10 years annualized growth rate still stands at 8.20%, which is still good considering the cut in profits. The same can be seen in their net income. Even with their net profits cut in half, their 10 years annualized growth rate is still in a positive 7.81%. For how well they produce net profits from their revenue, their net profit margin is averaging around 24 to 28% in the past years. This is well in line industry average if you compare it to other real estate companies in our country. For their equity, they've been consistent in their growth for the past 10 years. And for their latest 12 months, though it's in a slight negative growth, we still have yet to see their finalized 2021 financial statements, so this still may change. For that, their 10 years annualized growth rate is 13.77%, a good growth rate for them. For their free cash flow, they stacked up quite a bit for the pandemic years, which is a good move for them considering their business was greatly affected. As for how well the company is managing debt, their debt-to-equity ratio is only at 0.77, meaning they only have 0.77 pesos of debt for every 1 peso of equity, which is a good ratio. And for their current ratio, they have 3.34 pesos of current assets for every 1 peso of current liabilities, meaning they can pay up all their short-term obligations in an instant and still have more to spare. With this, they are managing well their debts. For my buy price, my computed intrinsic value is 5.09. With a 30% margin of safety, I have a buy below price of 3.56 pesos. Last company for today is Puregold, a very well-known retail company in the Philippines. Now their price had already recovered back then, but went down again this month. Looking at their financials, their revenue had been growing consistently for the past 10 years, even amidst the pandemic, thus having a 10 years annualized growth rate of 19.20%. And for their net income, same story, growing consistently year after year, even during the pandemic, growing at an outstanding 10-year annualized rate of 35.89%. As to how well they are producing net profits from their revenue, like most retail businesses, they average around 4 to 5.5%. For their equity, like their profits, they've also been growing consistently without fail for the past 10 years, growing at an annualized rate of 42%, and for their 7 years growth, it's at 12.21%, so a good growth as well. For their free cash flow, they've also stacked up free cash on hand during the pandemic season. And as to how well they manage their debt to equity is only 0.77, meaning they only have 0.77 pesos of debt for every 1 peso of equity. And for how well they are handling their short-term debt, their current ratio stands at 5.78, which means they are more than capable of paying up all their short-term debt. With this, we can say Puregold is managing its debts well, so good revenue growth, net income, equity, plus a very well-managed debt. With that, my computed intrinsic value for them is at 60.5, having a 30% margin of safety. My buy below price is at 42.36. So this ends this video for today. Though the stock market is going wild this past few days, there's still a silver lining in it. We can buy great companies at a discount. Now if you want to know more details about the companies I've shown, there's a link down below of my stock analysis video for each. So I hope you've learned something from this video. And if you did, before you leave, I would appreciate it if you would click the like button. And if you want to learn more about finance and investing, do subscribe to the channel to be updated whenever I post a new video. Thank you and see you in the next video.